Stop what you're doing. Look around you. Because the next economic shock won't hit America all at once. It will hit your state first. Your home. Your taxes. Your savings. Everything you depend on is about to be tested, and nobody is warning you. Your taxes. Your pension. Your home equity. Even your local banks. Everything depends on your state's financial strength, and many states are far weaker than people think. This isn't a minor budget problem. This is mathematical insolvency, the moment when the numbers stop adding up, the money disappears, and the essential services your community depends on begin to break down. Today, I'm going to reveal the 7 U.S. states most at risk of financial failure, based on hard data, pension funding ratios, unfunded liabilities, population trends, tax burdens, economic dependence on shrinking industries, and exposure to the coming commercial real estate crisis. And more importantly, I'll explain exactly what you need to do right now if you live in one of these states, before the situation becomes irreversible. Because by the time the mainstream media finally admits what's happening, it will already be too late to protect yourself. Let's begin. Number 7, Kentucky. Kentucky's financial foundation is cracking under the weight of its pension system. The state's pension funds are less than half funded, sitting around the mid-40% range, one of the weakest ratios in the country. Kentucky owes tens of billions in pension promises that it simply does not have the money to pay. To put it in perspective, nearly 1/5 of the state's entire economy is tied up in pension debt. Over 400,000 public workers and retirees are expecting benefits that the math cannot support. The state faces a brutal trilemma: it cannot legally cut benefits without triggering constitutional battles, it cannot raise taxes enough without driving residents out, and it cannot grow its economy fast enough to outrun the debt. When the next recession hits, and state revenues fall 15 to 20%, Kentucky will be forced into impossible decisions: default on pension payments, or slash essential services. Property taxes will surge as the state scrambles for revenue. Expect increases of 20 to 30% within a few years, pushing homeowners to the brink. If you live in Kentucky, understand your pension is at risk, regardless of legal protections. Diversify your income streams immediately. If you own property, consider selling before tax hikes accelerate. Move liquid assets out of state-exposed banks. Kentucky is not collapsing tomorrow, but the trajectory is unmistakable. Number 6, New Jersey. New Jersey's financial crisis is deeper and more entrenched. Its pension system is funded at barely above 40%, even worse than Kentucky. The state carries over $100 billion in unfunded liabilities, and its property taxes are the highest in America, averaging nearly $10,000 per household. New Jersey is trapped in a vicious cycle. High taxes push residents out, the tax base shrinks, the remaining residents face even higher taxes, more people leave. In 2023 alone, tens of thousands of residents fled the state. And the people leaving are overwhelmingly middle and upper income earners, the very taxpayers the state depends on. New Jersey's economy is heavily tied to financial services, a sector facing massive AI-driven job cuts. As Wall Street eliminates layers of middle management, New Jersey loses income tax revenue, property tax revenue, and consumer spending simultaneously. Credit agencies have already placed the state on negative outlook. One recession could push New Jersey's bonds into junk status, making borrowing more expensive at the worst possible time. If you live in New Jersey, expect property taxes to rise another 25 to 35% in the next few years. Home equity will erode under the weight of tax burdens. If you can sell, consider doing it before the next wave of outmigration. Move savings to out-of-state institutions. If you run a business, relocating may be the difference between survival and failure. New Jersey is already in the doom loop, and it's accelerating. Number 5, Connecticut. Connecticut is a state where the wealthy carry the entire system on their backs, and they're leaving. The state has over $70 billion in unfunded pension and healthcare liabilities. Its pension system is funded at under 50%, meaning more than half of promised benefits have no money behind them. Connecticut's top 1% of earners pay over 40% of the state's income tax. When even a small number of high-income residents move to Florida or Texas, the entire budget structure begins to wobble. The state has already raised income taxes, corporate taxes, and property taxes, and it still can't close the gap. Real estate tells the story clearly. Home values in many areas have been flat or declining for over a decade, even as taxes rise year after year. Connecticut's economy relies on three sectors: finance, insurance, healthcare. All three are facing structural disruption, from AI, consolidation, and federal budget tightening. If you live in Connecticut, high earners should strongly consider relocating before further tax hikes. Middle-class homeowners should evaluate selling before prices fall further. Pension recipients should prepare for 30 to 40% reductions. Keep assets in banks outside the state. Connecticut is entering a long, grinding decline, and the window to exit cleanly is closing. Number 4, Hawaii. Hawaii is uniquely vulnerable because of its geography and economic structure. The state's pension system is funded at just over 50%, but that number assumes unrealistic investment returns. If returns fall to 3 to 4% during a recession, Hawaii's funded ratio could collapse into the 30% range. Hawaii's economy is almost entirely dependent on tourism, which drops 40 to 70% during major downturns. When mainland Americans lose jobs, vacations are the first thing they cut. The cost of living is already nearly double the national average. Housing costs are triple the U.S. average. Groceries cost 50% more because everything must be shipped in. When incomes fall, residents will be trapped, too expensive to stay, too expensive to leave. Wealthy residents who leave rarely return, and once they're gone, the tax base evaporates permanently. If you live in Hawaii, if you're not financially secure, consider relocating before the next recession. If you own property, selling before tourism collapses may preserve your equity. Workers in hospitality should prepare for prolonged unemployment. Pension recipients should expect major cuts. Hawaii's beauty hides a fragile economic reality. Number 3, Illinois. Illinois is the closest thing America has to a state in slow-motion bankruptcy. The state carries over $300 billion in total debt, with pension systems funded at around 40%. Chicago, the economic engine of the state, is losing residents at an alarming rate. Commercial real estate vacancies in downtown Chicago exceed 20%, and rising. The city itself carries tens of billions in debt, separate from the state's obligations. Illinois has the second worst credit rating of any state in the country. It pays higher interest rates than many corporations. Property taxes in Illinois are among the highest in the nation, and still rising. Cook County alone saw increases of over 30% in the last decade. The state constitution prohibits pension cuts, meaning Illinois cannot fix its financial crisis without federal intervention, which is unlikely. If you live in Illinois, consider selling property before values fall further. Businesses should evaluate relocating to neighboring states with lower taxes. Pension recipients should prepare for the possibility of historic benefit reductions. Move liquid assets to out-of-state banks. Illinois is already deep into the doom loop, and the spiral is accelerating. Number 2, California. California is massive, but not invincible. The state's pension system, CalPERS, is funded at around 70%. But that masks a nearly $200 billion shortfall. And that shortfall grows rapidly when investment returns fall. California has lost hundreds of thousands of residents in recent years, and the people leaving are overwhelmingly high earners. The top 1% of taxpayers provide half of all income tax revenue. When even a small fraction leave, the state's budget collapses. California relies heavily on capital gains taxes from tech wealth. When markets fall, California loses 30 to 40% of its revenue overnight. Commercial real estate in San Francisco is in free fall, vacancy rates above 35%, property values down 40%, and entire buildings being surrendered to lenders. Infrastructure is deteriorating, with over $200 billion in deferred maintenance. If you live in California, high earners should consider establishing residency elsewhere before new taxes are implemented. Commercial real estate owners should prepare for long-term declines. Homeowners in coastal cities may want to sell while foreign buyers still exist. Pension recipients should expect cuts despite legal protections. California is too big to fail, but it is failing anyway. Number 1, New York. New York is the most financially vulnerable state in America. Why? Because its entire economy depends on one industry, finance. And finance is undergoing the most aggressive AI-driven restructuring in history. Wall Street is eliminating 40 to 50% of white-collar jobs, permanently. These jobs paid $150,000 to $400,000 and generated enormous tax revenue. New York City provides 60% of the state's tax base. But commercial real estate in Manhattan is collapsing. Vacancy rates above 20%, falling property values, and shrinking demand for office space. The city carries over $200 billion in debt. The MTA alone has $50 billion in obligations and ridership still far below pre-pandemic levels. New York's pension system appears well-funded on paper, but only because it assumes nearly 6% annual returns. In a downturn, that funded ratio could fall into the 60% range, creating tens of billions in new unfunded liabilities. If you live in New York, workers in finance should prepare for rapid automation. High earners should consider relocating before wealth taxes are implemented. Commercial real estate owners should expect a decade-long downturn. Pension recipients should prepare for significant cuts. Move assets to banks outside the state. New York is entering a full-scale fiscal storm. All 7 states share the same warning signs: massive unfunded pension liabilities, shrinking populations, dependence on vulnerable industries, rising taxes, deteriorating credit ratings, collapsing commercial real estate markets. The crash will begin at the state level. By the time it becomes a national crisis, millions of people will already be trapped. Diversify your assets geographically. Don't keep everything in one state's banks or real estate. If you live in one of these states and can move, consider it. If you can't move, prepare for higher taxes and reduced services. If you receive a state pension, assume 40 to 50% cuts. If you own property, evaluate selling before values fall further. If you own a business, consider relocating to states with growing populations like Utah, Idaho, Tennessee, Texas, Florida, North Carolina. If you're young and building a career, choose your location strategically. The collapse is already baked into the numbers. The only question is whether you're positioned to survive it.